Thank you, ladies and gentlemen. My name is Prashant Bojani, and I'm going to be your host for today. On behalf of the Rappaport Group, I would like to thank each and every one of you for your kind presence here, especially to all those people who have stayed back or traveled from different cities and countries to make it here today. We are indeed privileged to have all of you with us, and I would like to thank all our speakers, guests, media, and all our delegates who have made time from their busy schedules to be present between us. Special thanks to our sponsors for the event, Kiran Gems, IGL, Independent Gemological Laboratory, EGL, European Gemological Laboratory, BVC Group Logistics, Brinks Global Services, the Art of Jewelry, and the Wadhwa Group. Thank you everyone for your kind support. I would now call upon stage Ms. Pooja Kotwani, the Managing Director for Rappaport India Private Limited, to introduce our guests of honor.
Good morning, everybody. It is with great pleasure that I welcome our guest of honor, Shri P.M. Salim, Commissioner of Customs, to the Rappaport International Diamond Conference 2012. Shri P.M. Salim is a double graduate in Science and Law and a postgraduate in Management and Business Administration with specialization in Marketing Management from the Indian Institute of Management, Calcutta. He started his career as a marketing manager in a private sector and later at Steel Authority of India Limited. He joined the Indian Revenue Service in 1983 and served as Assistant Collector of Central Excise at Coimbatore and Nilgiris, and later as Assistant Collector of Customs and Madras Customs House. His name is known in anti-smuggling field, and he has smashed the smuggling syndicates operating in the Chennai Seaport and Chennai International Airport. Shri Salim also worked as Under Secretary to Government in India in the Ministry of Finance at New Delhi and piloted a number of legislations, especially in the doctrine of unjust enrichment. Besides being Vigilance Chief of the Department for South Zone, he also crossed swords successfully with legal luminaries at CESTAT Bangalore. Shri Salim is an active sportsman and was a university player in basketball and hockey. He has led the NCC contingent in Republic Day Parade at New Delhi and is a paratrooper and a mountaineer. He is widely traveled and is a popular figure in seminars, symposiums, and public functions. He is presently the Commissioner of Customs at Mumbai International Airport, under whom the Precious Cargo Customs Clearance Center at Bharat Diamond Bourse currently functions. I now call upon Shri P.M. Salim to inaugurate the conference and kindly say a few words. Please.
Good morning to all the participants, guests, colleagues, Mr. Rappaport, Mr. Kothari, and all the dignitaries. Ms. Pooja has read out quite a lot of these things. Anyway, thank you for this, Ms. Pooja. I am very glad to be here, and grateful to Mr. Rappaport and the Rappaport Company to have invited me to this, because it's a great occasion to have an interaction with you. Though I am, because of my other preoccupations, I won't be able to stay for a longer time. However, it's a great pleasure. And also, I am thankful to Rappaport on my own behalf and the department's own, and on behalf of the country also, that they have brought this seminar for the first time to India. And I hope and wish that it will continue. And by our clients here, our trade here, they will force them to also continue with these seminars in the coming years also in India. I would like to say only a few words on in this occasion. Don't want to take much time, only 5 minutes. But I would like to say a couple of words, couple of points, which when I was called for this thing also, then even otherwise also has been going through my mind as when I came over took over this charge and the Bilateral Diamond Bourse and the precious cargo customs clearance center is under me, through which the 90% of the country's diamond moves. Last year it was 1,10,000 crores of diamonds which was imported, and 1,17,000 crores which was exported through the Bilateral Diamond Bourse alone. So it's a volume you can imagine. So I was thinking, see, our field is customs is not, this is only a very small area. In fact, only very few places we come across this type of work. So when I came into, I was very much interested, why the diamond industry and all that. And I was thinking, now as we all know, and what the people forecast, the people who are learned forecast is that India is going to become an economic power, maybe the second or third or definitely fourth in the very short period of time. So with that background, how does the diamond industry come into the picture and what does it brings out for the diamond industry? One thing which I was thinking is, by the diamond industry, whatever I have learned of the period of time, has been always looking outward from India, and has been focusing on the international side of the business. With the Indian economy growing and with the small nucleus type of family coming, double income, triple income, and all this coming, we will have in very short time, we already have and we are going to have in the short time, a large upper middle class and a upper class who would be in the market for the diamonds. Whereas we have been concentrating on the outside, now we have to turn inward also. This is a big market because of the population, because of the number of people involved, because of this becomes a big market. Our trade has to also concentrate on this thing. So I was thinking, why diamonds is not being sold that well in India? Why Indians do not go in for diamonds on that? Apart from the earlier, of course, it was out of reach maybe. But even then, some of the smaller level, this thing was within the reach. But even then, we were not taking it. Why I was thinking, as a layman, as an Indian, as a person who is also a middle class family, why? Why? Because we go for gold. We go for gold, and gold can be bought, gold can be sold. We also look at it as an investment. We do not lose. See, as Indians, we always think about what is the money, where the money goes, whether it goes down the drain or I can recover it later. You look at the LIC, life insurance policies. We go for money back policies. The whole world goes for endowment. We go for the money back because we don't want to lose the money. We will pay the premium, but once the premiums are over, we want the money to get back. We get back the money. Same mentality is there in the business of this diamond and gold also. Why I am saying this is that our mindset has to change, so that, and our policies has to change, and our procedures has to change, so that the people who buy the diamonds will be able to recover the money. For that, Rappaport and GIA and other people can make a lot of contribution. Why we are not able to sell it is because the certification is not there. It is not readily saleable. We should come to an environment where it can be sold. At least a minimum price should be guaranteed. When I buy a diamond jewelry, when I sell it, I should get a minimum guarantee of certain money. If that is there, Indian market will grow 1,000-fold. With the new generation coming in, they don't want gold just like gold. They want aesthetics. They want smaller items. They want studded with gold, maybe studded with diamonds. They want better designs. They would go in definitely for that, but if they can also get the money's worth. So this one point which maybe, I don't know, this is my reading of the things, I may be wrong, but I thought I will put this across to you to think for you, and how we can have the systems change that thing. And the certification. And the certification is not for the higher ends alone, for the middle ends, for the lower ends, for the jewelry type of this thing is there, not for the trading alone. That type of things we get, then the industry can go. And for that, we have to have certification laboratories in India, which can be done very fast. We can do it fast. We should have a system like a gold type of hallmarking and other type of systems and all that. This is the, what I see, this is the path which we have to take. This is one point which I wanted to say for the trade. Now for the, coming to the customs, I was just having a 10 minutes talk to Mr. Rappaport. I was quite impressed by his vision and how they are doing it in the world. Now, as far as India is concerned, as far as customs is concerned, we are for the trade. Let me repeat it. We are for the trade and industry. We always look at from the point of view at the higher level. I'd look at the point of view how we can be a facilitator to the industry. Gone are the days when we were enforcers. We used to catch people, we used to enforce this thing. Those are gone the days. It is force as a democracy, as I was telling Mr. Rappaport. In a democracy, the government, the enforcement agency has to change according to the wishes of the people, because the people are the public, is the masters. The policies has to change. The outlook has to change. If it is not changed today, he was saying that the government has got a lot of regulations and all that. I was assuring him the regulations will change. It has to change because people will force it on them. Trade will force it on the government. And government has to respond. And customs traditionally has been a very responsive and very responsive department. We look at the points when it comes, we take decisions on the spot. I was telling Mr. Rappaport also, we take decisions on the field level, at the ground level. Because we have been doing it day in, day out. We have to do it because the consignments come, consignments goes, diamond is only one small portion. So we take decisions. We take policy decisions. We don't stand on the bureaucratic rules and regulations. At the higher levels, we try to see what are the ways. We have done so many, we have done in the last also. Rappaport itself is aware that we have done. Because 5 crores unit only could send it abroad for certification. I said, we will take the shipping, even though Rappaport is not a exporter. Exporter is you people, clients. But we said, Rappaport, we will treat it as the shipping bills of this thing is there as the Rappaport's export, as GIA's export, so that they will be able to send it. If you take a rigid view, then it will be catastrophic. Same way, we are also, for just because I don't want to take time, because we are also thinking of many other ways. Just now Mr. Rappaport was telling me, we want to develop India as a trading hub, because Rappaport is the trader, the international trader. So they want to develop India as a hub for trading. We welcome that. Customs welcomes that, the country welcomes that, India welcomes it. Because then Indian economy will grow. People will get more jobs, economy will grow, the trade will grow, industry will grow. It's a win-win situation. For what customs can do on that? I have just now told him. Just I was thinking out, how can we do it? We can do it. Because, for example, let us look at this room. We can declare this as a customs bonded warehouse. I can declare this as a customs bonded warehouse. Rappaport can bring the diamonds here. Through the airport, is a escort, it will come here. You can auction it here. You can sell it here. Once it goes out of the room, we will charge duty, if it is dutiable. But when it comes out, comes into here, no duty. If it goes back out of the country, no duty. If the person in India buys it and takes it out of this thing, then only they have to pay duty. This becomes a hub. The persons from other places can come here and do it. Singapore fellow can come here and buy it, take it to Singapore. It becomes a duty-free type of area. I can do it in Bharat Diamond Boards. I can do it any place. If you provide the space, Bharat Diamond Boards prices. German Generally Export Promotion Council, Mr. Kothari is here, can do a lot of things. They are proposing that. Now bonded, they have also proposed that we can bring rough diamonds into a bonded warehouse and all that. This issue has already come up. We have already, as far as we are concerned, we have already recommended. Now it is between Commerce Ministry and Finance Ministry how to go about it, because rough diamonds doesn't have a duty. So only when the duty is there, there is a necessity for a diamond, it's a bonded warehouse. But the trade wants it as to be done as a bonded warehouse. We are for it. TK, you bring it. As long as it is, the entire activity is done within the premises, bonded warehouses, we have it. Bring rough diamonds, do whatever you want to do within the bonded warehouse, take it out of the country, auction it, everything. As when it goes out of this thing into our domestic market, only customs will come to what we should do. Whether to collect rough diamonds, there is no duty. So there is no duty also on that. So that way, we can be very, why I am saying is, when we have a dialogue, when we look at the problems, we are always ready for coming out and trying to help the industry grow. Simply because if you grow, then only the nation grows. If the nation grows, you grow, only I get my revenue, my duty. So it is, as I said, it's a win-win situation for everybody. So any activity in that, rest assured that we will be always with you. With these words, I would like to conclude, because I don't want to take time. I would again thank you, all of you, and I wish this seminar a very grand success, and it is going to definitely benefit all the participants. They will have a lot of ideas, a lot of knowledge on this. Report is bringing out a lot of, as I saw the schedule and all that, there will be a lot of things. Please take advantage of that. We want to learn. Knowledge is the greatest weapon in the world. So please be after it. Good day. Thank you.
Thank you, Shri PM Salim, for the kind words, the valued information, and most importantly, leaving us with thoughts to better the industry. I now call upon Mr. Martin Rappaport, Chairman of the Rappaport Group, to please give a token of our appreciation to our chief guest. Please join us on stage. Shri Salim, please.
Where's the token? It's coming. Okay, it's coming. It's coming. Okay. Oh, yes, thank you so much. In the corner? Okay, so people can see. Okay, photograph. Okay. I have no idea how this works, but thank you so much. Yeah, please. Thank you. I'm not supposed to really speak now, but I just wanted to say that, sometimes when we come and work in India, we get very frustrated because things are difficult and there's so many laws and red tape and bureaucrats. But I think what we're hearing from the Commissioner of Customs here is that, in fact, there is a solution. And it's human relations. It's our ability to talk and communicate. It's a government that does have an open and sensitive ear to us. So the fact that the things sometimes are difficult are more than compensated by having a good communication and a good relationship with the people in government who make the decisions. And the Council has done, I know Sanjay and Vasant have done this for many years, and I'm hopeful that we will be able to continue as an industry this excellent relationship, and particularly with Customs. And we really want to thank the Commissioner for taking the time today from his busy schedule to be with us. I understand I hand it back now to our moderator.
Thank you. Technology plays funny things at times. Anyways, before we start, I would like to give a quick introduction to the Rappaport Group. The Rappaport Group provides first-class, authoritative services that support the development of free, fair, efficient, competitive, and profitable diamond and jewelry markets. Established in 1976, the group has over 13,000 clients in 95 countries. The group activities include published materials, electronic information services and trading networks, diamond grading and certification, global trading and auction services, consolidated international shipping, international sourcing, quality control and compliance services, and localized financial, research, and marketing services. A primary and unifying focus of the group are knowledge-based information services that create transparent and efficient markets. Examples are the Rappaport Price List. Established in 1978, it is the primary source of diamond prices and market information. It is the international benchmark used by dealers to establish diamond prices in all major markets, which we all commonly refer to as the Red Sheet. The Rappaport Group also publishes the Rappaport magazine, which covers comprehensive news related to the diamond and jewelry industry. Rappaport has also pioneered the RapNet, which is the world's largest diamond trading network with daily diamond listings of close to 1 million diamonds, valued at $6.21 billion. Our other popular service include auctions, where companies successfully sell more than 50,000 carats of polished diamonds every month. Our other services include the GIA Lab Direct, diamond grading and certification services, along with the Rappaport Fair Trade Jewelry Initiative. The Diamonds.net portal supports our 24/7 Rappaport news service. Our dedicated team of 180 highly skilled professionals, our sophisticated information and data management technology, our global reach, independent perspective, and total commitment to providing our clients with consistent first-class service are what have made Rappaport synonymous with the industry standard in the diamond world. A little bit about the Rappaport International Diamond Conference. Each year, Rappaport hosts a premier international diamond conference in New York to address the most pressing topics facing members of the diamond and jewelry industry. This year, the Rappaport International Diamond Conference is being strategically located in Mumbai. As said by Mr. Martin Rappaport, as diamond demand and prices go through a boom-bust cycle, India is the market to watch. While the US and China are important sources of diamond demand, how India handles rough supply and polished demand will define short-term recovery opportunities. It gives me immense pleasure also to inform that this is the 10th anniversary of Rappaport India, where Rappaport has been committed to service the diamond and jewelry community. Before we go ahead, just a brief history of what the Rappaport International Diamond Conference is all about. It's always ahead of the curve. Rappaport Conference brings you the inside story before it becomes news. For your business to survive in these unpredictable times, you need to be able to make informed decisions backed by clear thinking. The Rappaport Conference delivers in-depth economic analysis supported by Rappaport's cutting-edge research to empower your decisions with knowledge. Each conference features a highly anticipated presentation by Mr. Martin Rappaport, along with the latest economic and industry analysis delivered by the most respected experts in their field. Topics are geared towards understanding the global financial markets and their impact on diamond suppliers, retailers, consumers, investors, and government regulators. As the world undergoes drastic and uncertain transformations, Rappaport gives you the information to develop strategic solutions to help you work smarter and turn your challenges into opportunities. The former conferences have addressed issues such as the new economics of globalization, the rise of India and China and its effect on America, the decline in mining and the loss of manufacturing centers, the role of future technologies, and the relevance of branding and marketing. In addition, the Rappaport Conference always brings to the forefront the issues of social responsibility, which are rarely touched upon at other industry events. Human rights, conflict diamonds, and the Kimberley process are issues that demand our attention, are included in every conference agenda. So, ladies and gentlemen, without further delay, let me introduce you to our first speaker of the day, Mr. Avi Kravitz. Mr. Avi Kravitz is the senior editor at the Rappaport Group, where he provides extensive content and analysis about the diamond industry for Rappaport's various publications and products. Prior to joining Rappaport in 2007, Avi worked as the chief business correspondent at the Jerusalem Post, the leading English daily newspaper in Israel. Born in South Africa, Avi moved to Israel in 2002. He has a Bachelor's of Commerce degree from the University of Witwatersrand in Johannesburg with majors in business finance and accounting. He currently resides in Tel Aviv. I would now like to welcome Mr. Avi Kravitz to come up on stage and share with us the diamond facts and figures. Ladies and gentlemen, Mr. Avi Kravitz.
Good morning, everyone, and thank you, Prashant, distinguished guests, Shri Salim. Firstly, I'd like to echo what the Commissioner said about the potential of the Indian market, and I think we need to stress that it's one of the exciting stories that we've seen in the last few years, that the Indian domestic demand has played a role in the recovery since the 2008 recession. But it's also played a role in presenting some challenges that we've seen in the market in 2012. And I'd like to present this morning a brief synopsis, and I'm going to try and keep it as concise as possible, of what's happening in the diamond industry in 2012, particularly a reference to the first half of the year. And I'm afraid it's not going to present an overly optimistic picture, and may even exaggerate the reality a bit, but I think the mood all around has reflected a similar sentiment this year, especially in the second quarter and leading up to this week's show. So it doesn't take a genius to, and with the fear of stating the obvious, this year has been a year of economic uncertainty. We've been bombarded with news about the Eurozone. Should they bail out this country or that country? By how much? Should Greece stay in the Euro? And that has spread to other markets, in particular emerging markets such as demand for Chinese and Indian products has been affected. We're also getting mixed messages from the US economy, with the election year bringing economic promise, but the economic data isn't quite showing that promise to a full extent. So the bottom line is that we're really living in an interesting year and in interesting times, and I think what we want to get out of this conference is whether that is, all these challenges are a blessing or a curse, and how we react to them. So what's been the impact on the diamond industry? For one, the uncertainty brings consumer caution, which is filtered to the trade. And we're seeing that Chinese consumers have been holding back and have been out of the market, as have to an extent Indian consumers. And there's been a shift back to reliance on the US market, which has been a stalwart of stability in 2012. We're also seeing liquidity being squeezed and tight profit margins in the manufacturing center. And in an uncertain economic environment, consumers tend towards more affordable categories of product, and certainly diamonds are no exception. So while this has happened, the industry has also reacted by curbing the volume of goods that are coming through the pipeline, and changing the type of diamonds that they're providing to the market. And we'll see that as we go through my presentation. And that trend of curbing production really started in 2011. And I'm sorry, I think we're missing there's a bit of a technical issue, but we're missing a few numbers here, but I'll talk you through them. In 2011, which is the most right-hand side bar, it shows that the production by volume, which is the blue bar graph, was slightly down by about 3%, while the line graph shows an increase of the value of production that came to the market. And really, it was a year of two halves. We saw a very strong first 7 months of 2011, which was defined by an aspect of speculative trading that was driving prices high. And then the market started to correct it after, really at the start of the IIJS show, if you remember correctly, when we started to see some cracks in Indian liquidity. And that difference between the volume of goods coming to market and value is really a difference of price. And this is Kimberley Process data, which shows that the average price of production, of global production, rose by about 31% to $116 per carat in 2011. And we see that in each of the different countries which are producing diamonds. But Botswana's values went up by 51%, but the carats that it was producing went up just 4%. And if you go down that list, you'll see similar trends across the board. So overall, where diamonds are being produced pretty much stayed the same. And we saw, as we see, that Botswana has the chunk of the value production, while Russia has the chunk of volumes. And I want to stress in this graph, in these pie charts, the small nature of the mining sector, because if you see that, if you consider that Alrosa has a dominance in Russia and Angola, and De Beers in Botswana, Canada, South Africa, etc., that those two companies really take the chunk of production. And certainly by value, they hold about 75% of the market. And the top 5 producers hold about 65% of volume production. So when we say that we saw that uncertainty starting in 2011, already in the fourth quarter, De Beers was saying that they were focusing their mining on maintenance and waste production, taking advantage of the softer market to do so. And we also started to see some price weakness at the rough tenders, and diamond dealer speculation that was such a factor in the first half was not a factor anymore at all. Came the season, Diwali, Christmas, Chinese New Year were okay and pretty much in line with expectations, but overall, but there was this underlying sort of caution that was setting into the market, and that carried through to the first half of 2012. So this year, what we've seen on the production side is that the two major producers, De Beers and Alrosa, have cut their production by about 12%, and the top 5 producers together combined had production about 7% below 2011 figures, and that trend again, and that trend intensified in the second quarter when again, we saw in 2012 kind of two periods within the year, that in the first few months there was some signs of stability, and then the market started to present tougher challenges overall. And in fact, the mining companies started to increase prices at the beginning of the year to some extent. But came the second quarter, April, May, site holders started to reject goods. Rough trading on the secondary market was very weak, and we saw recently that Alrosa has started to sell goods to the Russian treasury again, which is the first time that it's done that since the 2008 crisis, which is a signal of a weaker market, that it's not selling to the general trade. On the trading side, we see lower numbers also in the trading centres. Belgium's numbers were down both by value and volume in terms of its rough imports and exports. The same with Israel. And interestingly, India's numbers were up in the first half of the year, and that tells us a few things. People have explained to me here that the larger manufacturers have continued to buy rough because they want to feed their factories and not lose the workers to the same extent that they did in 2008. But it's also saying that they are paying the price that De Beers, Alrosa, and the mining companies are setting for the goods, even if they may be overpriced. And that has led to and that has contributed to the liquidities, the tough liquidity situation that we're seeing that we've heard about in the market to date. And we're also seeing that that polished inventories amongst the larger Indian manufacturers have risen in the first half of the year. So we're seeing high polished inventories and possibly low rough inventories, although it could be that a lot of the manufacturers are holding rough until they can sell them onto the market at more profitable rates. And it's also a question of what type of inventories are being held in the manufacturing center. If they have the right type of goods, the more popular SI lower goods that seem to be moving strongly at the moment. And of course the shift to fancies that we've seen. This is again, I apologize, we're missing some of the data here. But if on the far left-hand side of this graph is 2008, and the far right is the present time. This is our estimates of DTC rough prices. And we see that there has been a steadier decline so far this year. And we estimate that prices have come down by about 4 to 5% since the beginning of the year, and are down about 18%, 17-18% since 1 year ago. And we're also hearing that this week there was some sharper adjustments than usual from DTC, as well as from Alrosa a week or two ago. Which many were hoping for, and which makes sense given the lack of demand and the lack of trading of DTC boxes in the past 2 to 3 months. Just to compare that to some of the mines that are selling goods on tender, Letseng, the high value Letseng mine has had its prices drop 23% on average in 2012 compared to the average of 2011, which Cullinan down 18%. So it seems that there's stronger fluctuations at the tender side than on the contract suppliers. Comparing this to our polished prices on RapNet, we see the far left-hand side is the beginning of 2011 to present time. And we see the sharp increases that we saw in the rough market exceeding those in the polished being the blue graph at the bottom, and the gap really representing the tighter profit margins that the manufacturing and dealer community is having to deal with. And we saw that gap sort of widening in 2011 that has squeezed profit margins and liquidity even more so. So many are wondering if the market's bottomed out, if there's still room for further declines. Also, how different is this to the 2008 crisis? There are some similarities that perhaps the beginning of last year was a speculative market that caused a bubble that is now bursting over a longer period of time, whereas 2008 was a sharper decrease. But it is a longer sustained downtrend that we are seeing, and possibly a more difficult one to deal with and to recover from. So we want to also see what feedback we're receiving from the polished market. So I'm going to go through these next few graphs very quickly because they all really tell the same story, that also on the polished side, there are lower volumes that are coming through the pipeline. So we see in Belgium, with the exception of the value of its polished imports, its volumes are certainly down in the first half compared to last year. Same in Israel. Also in the consumer centers that they're importing fewer polished diamonds to the US and also to the Far East. And really the Hong Kong data illustrates the caution that the Far East market has shown, and certainly in the last few months. And then of course there's the Indian data, which shows really sharp decreases for a whole host of reasons that I'm sure will be discussed later today. I just want to really go through the numbers over here because just to explain the graph, the green obviously is 2012, moving 2011, 2010 next to it. Compared to 2010 in the 2011 in the calendar year, polished exports fell 41% to 9.4 billion. By volume, they were down 51%, and imports were down 76% in the half year, and by 70% in volume terms. So, as I said, that India seems to have been bombarded by all these factors that have influenced those numbers, primarily probably the most significant being the 2% import duty that was implemented in January, but also because there's been a decline in global demand for goods, and a softer domestic market, which has been influenced by the weaker rupee, the high gold prices as a result. There was a retail strike which impacted the market. But it's important to stress again that India is big enough to influence the market and influence that recovery, as Prashant mentioned, quoting Martin earlier, that India's reaction to rough supply and the way it deals with polished demand can really drive the recovery. So what are people looking out for in the next few months ahead of the holiday season? I personally have got some feedback from some of the US retailers that there is an underlying concern about pending supply shortages. They see the mining companies bringing fewer goods to production, and they see less goods coming out of the manufacturing centers. And it's not that they are ready to splurge on building their inventory, but they want to know that the goods are available if they need them to be. And really, what is the new reality is that they are holding lower inventories across the board on a retail level and are very careful to monitor the inventories, both in the US, in the Far East, and among the Indian retailers. And that's part of the new reality, as is this volatility that markets go up and down, and we need to learn how to deal with them, deal with that fact. And the good news is that there are opportunities to manage such markets. And I think a large part of this conference is to brainstorm ways to do that. That there are many challenges in the market, not only in terms of what's happening on the supply-demand side, also in terms of dealing with issues such as synthetics and social corporate responsibility issues, etc. But there are ways to deal with it, and I think there's plenty of room for growth. The other good news is that the mega forces that have shaped the market in the past few years continues to do so, with this massive globalization and growth in markets such as India and China. And that spells exciting times for the industry, and particularly the Indian market, which makes these interesting times, I think, really a blessing and provides opportunity for growth. So I thank you very much for listening, and I wish you an interesting conference, and I hope you take a lot from it. Thanks very much.
Thank you, Obi, for the wonderful insights, and we thank Mr. Shri PM Salim, who would be leaving us. Thank you very much, sir, for coming over. Well, right then, so Avi's probably shared the diamond facts and figures with you, and he's probably set the right tone for this conference to go ahead with the agenda which we have in our mind to discuss today. Our next session for the day is going to cover very insightful topics on India's new regulatory and banking environment. Our next speaker for the day is Dr. Suresh Surana. Dr. Suresh Surana is the founder chairman of RSM Astute Consulting Group, which has offices across 10 cities in India and about 950 personnel. RSM Astute Consulting Group is the Indian member of the RSM International, the 6th largest global network of accounting and consulting firms with a revenue of more than $4 million. Dr. Surana is a chartered accountant and a doctorate in business policy and administration. He is one of the most reputed tax consultants in India with specialization in international taxation, corporate structuring, and forex regulations. He has authored several articles in leading publications and is a regular speaker at various professional forums. He also sits on the board of several companies. Ladies and gentlemen, please join me in welcoming Mr. Dr. Suresh Surana.
A very good morning to all of you. I see a lot of smiling faces. In these days of economic downturn, what we just now heard, and the global uncertainty, and then if the topic is tax and cross-border investment, regulatory developments, most smiling faces turn into grim faces. But it is good to see a lot of smiling faces. I recently met a couple which was always smiling, always happy. So I was wondering, what is the secret? So I asked the husband, what is the secret? How can you be so happy in these times? So he said that, it's very simple. We have divided the work and the responsibility between my wife and myself. All the major decisions are taken by me. All the minor decisions are taken by my wife. So that looked like a very magical formula. It can solve problem for a lot of us. So then I asked that, if you can explain more, what are the major decisions, what are the minor decisions? He said the major decisions are that, when should US attack North Korea, whether we should hang Kasab or not, whether our parliament should function or not. So these decisions I take. All minor decisions, where to buy the house, which car to buy, where to make investments, are all taken by my wife. So anyway, we are going to discuss only, 3 major topics. Basically, the whole objective is to discuss the recent developments, and we are not going to go into whole detail, but what are the burning issues which are facing the gem and jewelry industry right now. So the 3 topics, one is the cross-border investments, the second one is transfer pricing. I think many of you are facing those issues, and the third one is the service tax net, which has been widened from 1st July 2012. Are you able to see it? I think the diamond industry is a truly global industry. If you really see, we have the mining countries right across, the African, if you really see so in terms of the South African region, we have Botswana, we have South Africa. You have the diamond trading hubs, which are in Israel, Belgium. You have manufacturing hubs, India, China. And then you have the diamond consuming centers, which are US, Hong Kong, and Japan. So this is a truly global business. So there is a lot of cross-border investment. We have seen large number of companies from Belgium and Israel investing into India. We have also seen large number of Indian companies investing into US, Hong Kong, Botswana, and Japan. So this brings the issue about the cross-border investment. And it is a very large industry. It is almost $42 billion industry last 2 years. 16% of total India's exports is the gem and jewelry industry, with India accounting for 90% of the total diamonds in terms of the volume. So this is a truly, where we are having a global leadership. And the global industry is more than 100 billion. So this is one sector where foreign investment is generally freely permissible. So if you are doing wholesale trading here in India, and if you are a foreign company, you are allowed to invest under the automatic route. If you are doing manufacturing in India, diamond and jewelry both, you are allowed under automatic route. If you are doing retail trading, if it is a single brand retailing, then you are allowed to invest up to 100%, but you need FIPB approval for that. But multi-brand retailing, as you read every day in the newspaper, still it is not allowed. E-commerce B2B is allowed. But one thing which many people miss out, we have seen a lot of foreign companies make this mistake, that you cannot have a retail trading business in India, which is under the automatic route. And also the B2C. So if you are selling diamonds here, you must make sure that you are selling to another business organization if you have a foreign investment. So this is one aspect which I think many times people are missing out, and then it is resulting into the RBI taking action against those companies. As far as mining is concerned, again, up to 74% investment is allowed under automatic route. There are various reporting requirements. Once you get foreign investment, within 30 days, you must report to the Reserve Bank of India. Again, many companies miss out on that. And one important thing is that you cannot get foreign loans, from the parent company or from outside India for the purpose of working capital. So many companies have this problem. So typically, as I was just talking about, that you can have equity investment or you can have debt into Indian company by way of loans, but loan can be only for the purpose of if you are setting up a jewelry manufacturing unit for the capital expenditure. You cannot do for working capital purposes. So you need to be careful about that. Earlier, when a lot of foreign investment was coming into India, people were generally investing through Mauritius, Cyprus or Singapore, because of the double tax treaty benefit which India is having with these countries. Of late, we have seen that now people are preferring to invest directly because the tax authorities are becoming very aggressive. You have seen the Vodafone case, what has been happening there. So people prefer to directly invest and then they can get the tax credit in their home country. So this is another trend which we are talking. In this slide, I have summarized some of the major issues which are facing the foreign direct investment. So the first one we talked about is the tax environment, because there is an uncertainty when people invest, let's say through Mauritius or Cyprus, if the overseas company is sold, whether there will be taxability in India, which is the Vodafone situation we have talked about. Similarly, there is right now with India and Mauritius, the tax treaty is being renegotiated. So there is again an uncertainty whether this treaty benefit will continue or not. And the tax authorities are using very aggressive approach. They are looking through the treaties. Are you really managing the company in Mauritius or not? Are you managing it in Singapore or not? So these issues are also coming up. Another thing which has come up, that if you transfer the shares below the book value, the difference is deemed to be income in the hands of the transferee. So suppose if the company, in case your book value is, say for example, 10 rupees share is at 60 rupees. And if you transfer for 40 rupees, then the 20 rupees is deemed to be income in the hands of the recipient. So you have to be very careful, any transfer of shares, whether there is any, if it is below book value, then you can have a tax exposure. Another major thing which has come up is that even where you get foreign investment, not only within 30 days you have to report, every year you need to file a return with the Reserve Bank of India, which again many people think that only when investment comes, first year we have to file. But every year it is required to be furnished. In last budget, one change which came in, that if you issue new shares at a premium, even the premium which is in excess of book value or any other approved methodology of valuation, that will be deemed to be income. So for example, if the book value of your company is, for example, 60 rupees, and if you issue the shares at 200 rupees, then that 140 rupees can be deemed to be the income. So again, this is a new change which has come from 1st April 2012. You have to be very careful when you are doing the issue of new shares. The next major issue is the funding of working capital, which we already discussed about, that external commercial borrowing is not allowed for working capital purposes. You have to either have a bank credit line here of the packing credit facility or get an equity investment. Downstream investment permissibility and FIPB reporting. Now those who have received foreign investment into India, into an Indian company, if the Indian company makes further investment in second generation company, it has to be reported to the Foreign Investment Promotion Board. So again, many people miss out on that. I mean, we get requests all the time from companies who have missed out, and then we have to ask for the condonation. And the pricing of the shares. This has to follow the discounted cash flow method for the purpose of the exchange control regulations. Similarly, a lot of Indian companies have set up businesses abroad. So, in US or in Hong Kong, Japan, you can invest up to 4 times of your net worth under the automatic route. That investment can be in the form of capital, it can be in the form of loans, it can be in the form of guarantees. You have to do the reporting in form ODI, within 30 days immediately of investment. And but the major changes which are there in this, which I would like to talk about, from this financial year 11-12, which means whatever returns you are filing right now, you have to disclose all your foreign assets and any financial interest outside India in your income tax return. This was not a requirement earlier. So this is a very major change. Even as an individual, if you have invested under the $2 lakh scheme, there is a liberalized scheme under $2 lakh, many people have set up companies abroad. When you file your individual tax return or you file your company tax return, you have to give a list of all the overseas assets, which means all the overseas subsidiaries which are there. Now, many of the DTC site holders, because they have a globally integrated structure, while it was earlier being reported to the Reserve Bank of India, now it is also required to be reported to the income tax authorities from this financial year. If you get any dividend from your foreign subsidiary, this year there is a lower rate of tax. There is only 15% tax as against normal 30%. So if you want to bring any repatriation of profit into India, you can do it at a lower tax rate. The third point which I would like to mention is the controlled foreign companies. So if you have overseas companies which are not having active business, so if they are trading or manufacturing companies, it is fine. But if you have passive companies which are not doing active business, there is a new regulation which is likely to come in, which is called Controlled Foreign Company Regulation, CFC regulation, which will bring it into the tax net in India. So you need to watch out for this. And the last point on this one is the RBI's view on step-down subsidiaries. So if you have set up, let's say, a company in US, and the US company makes a further investment in a step-down subsidiary, you need to do the reporting, and Reserve Bank only allows one level step-down subsidiary, which means you cannot do subsidiary of a subsidiary and again in-turn subsidiary. So you have to be very careful. RBI is taking very much stringent penal action now on all these matters. If you look at the outward investment, which are the countries through which Indian companies are investing? So you will find that Mauritius, Singapore are the 2 leading countries. Then you have Netherlands, USA, and UAE. So most of the Indian companies which are investing outside India are investing through these routes, what we talked about. Now, very quickly on the transfer pricing, again, I think many of you have been dealing with the transfer pricing now for last few years with the tax authorities. If you do any transaction between the associated enterprises, which means your own subsidiary or with the same control and management, then income tax authorities want to see, or they want to be satisfied that the transactions are on arm's length basis, which means what you would pay to a third party or what you would receive from a third party who is not connected with you. So normally what you need to do is to do benchmarking study. You need to compare what the similar companies in the industry are making, what is your operating margin. You need to do a transfer pricing study and then do a reporting. Every year, along with the tax return, you need to submit a transfer pricing in terms of the certificate that your transactions with the related parties are on arm's length basis. Now, some of the major issues in this I have just summarized here. Every year we have seen that the transfer pricing authorities are becoming more and more, I would say, educated, more and more aggressive. So some of the key issues which are coming up, one is the treatment of interest and other income. So many of the companies have interest income. While calculating the profit margin, the transfer pricing authorities want to treat that as non-operating income and not to be treated as a diamond or of your jewelry profit margin, but they want to treat it as a non-operating income. So you need to be able to establish the nexus that whatever interest income you are earning is an integral part of the funds which are utilized for diamond business. Proper benchmarking with appropriate comparables. Within the diamond and jewelry industry, you can segment yourself. Are you a manufacturer? Are you a trader? Are you a large player? Are you a mid-sized player? So if you do proper benchmarking, you need to compare your profit margin with the comparable cases and not with the entire industry margin. Again, many times people don't do that properly. So I'm just talking of some activities which you can do to reduce your exposure. Another point is the interest on loans. Sometimes there are loans taken which are, the authorities are of the view are not pertaining to the diamond business. And therefore they disallow that interest. Foreign exchange gain and losses is the biggest, I would say, bone of contention with the tax authorities, that whether this is part of your operating income or not. So again, you need to do your homework on that. There is a possibility that part of your forex losses, to the extent it is amounting to hedging, you can even treat it as a part of the borrowing cost. And then it is definitely not an issue in terms of your comparing the operating margin. Many times you can justify that your operating margin, even though it may be lower, but you have not done any shifting of profits. So if you can show the financials of your overseas companies, suppose US or Belgium, most of those countries you do not have a very significant profit margin. So if you can show to the tax authorities that you have not really shifted the profit to the overseas companies, that also is a valid defense. Adopt industry norms, follow the herd. I think one of the, I would say, at the ground level, a principle which works very satisfactorily, it is better to stand in the crowd rather than stand out of it. So if the general industry margin in diamond industry is say 2 to 3%, it is better that you follow that margin. If jewelry industry is say 4 to 6%, you should follow that margin. Guarantees for overseas subsidiary. Last year, the tax authorities have taken a view that if you have given guarantee for your overseas subsidiary, you should be charging a guarantee commission for that. So again, you need to relook at all these things. The extended credit period. So if you are giving credit to your associate enterprise more than the normal credit period, say if you are giving normal credit of 4 months, but to your associate enterprise you are receiving money after 8 months or 12 months, they are treating that whatever is a deferment, there should be a higher realization on that account and making an adjustment for that. So it is very important for you to keep in mind all these exposure areas and to the extent possible minimize your exposure. One major thing which has now come in this budget is that now the transfer pricing will also be applicable to the domestic transactions. So if you are supplying diamond to your unit in Siege or you are supplying it to another SEZ unit, you will be subject to transfer pricing, just like international transactions were subjected to. And all the aspect which you need to do, like preparing a transfer pricing study and justifying that the price at which you have transferred is reasonable, you need to do here also. So this is another very major area which is now applicable from 1st April 2012. Some good news now. There was a proposal, as you know, earlier there was a situation that if the transfer pricing authorities come to a price which is within 5% of your price, they cannot make the adjustment. A 5% tolerance limit was allowed. This was proposed to be reduced to 3%. But just on 17th August, there is an announcement that the tolerance limit will be retained at 5%. So which is a good news. Some further good news is that advanced pricing agreement, there was a proposal which was there in Finance Act 2012, and now from 1st July 2012 it will become operational. The Central Board of Direct Taxes is expected to issue guidelines very shortly on this. So you can approach the authorities in advance that these are the transactions, let's say I'm going to do with my marketing arm. Is this margin acceptable? So, and once you sign the agreement with the tax authorities, that will be binding in your case. So this can help you to reduce your exposure. Another major thing is the safe harbor rules. The Prime Minister had constituted a committee which will finalize the safe harbor rules. Safe harbor rules means for each industry they will give the norm that in diamond industry this is the safe harbor margin. Similarly, jewelry industry, this is the safe harbor margin. So recently there is an announcement that by 31st December 2012 for all the industries they will announce the safe harbor margins. So please watch out for this and see that in diamond jewelry industry whatever safe harbor margin they allow, if you follow that you will avoid the exposure. So it is like following the herd. The last issue I would like to talk about is the service tax. So, as you probably know that from 1st July 2012, there is a complete change in the way service tax is being charged. Service tax is charged on most services at 12.36%. Up till 1st July 2012, it was chargeable on 119 services, which were listed. From time to time, they kept on adding various services. But from 1st July now, they have made that all services will be chargeable, except 17 services. So it is now a negative list, from a positive list to negative list. So unless you are in those 17, list of services, you will be chargeable to service tax. So I think we need to assess in our case, each of our case, are there any cases where there is service tax liability is increasing in your cost? But you may be liable to pay service tax on your inputs. I'm sure you are aware, many of the companies in Surat now have received notices for the reverse charge on the service tax. In the 17 services which are not liable to service tax, they've included trading of goods. So any trading you do, it is not chargeable to service tax. Any process which amounts to manufacture or production of goods. So any diamond manufacturing, job work, processing, that is not really chargeable to service tax. And any letting out of residential units is not chargeable to service tax. These are, 3 out of the 17 major headings. There is also a mega exemption notification which is exempting 39 other sub-services, which also you need to go through and see what is the exemption available in your case. But one thing which is clearly there, that any intermediate production process, so if you are part of the process, if you are giving it to some other job worker, that is exempted here. So that is again, I would say, some sort of relief there. In case of SEZ units, if you are availing services which are wholly consumed in SEZ, then you are exempted. Otherwise, you have to ask for a refund. So again, this is a change which I would like all of you to assess very carefully. It can increase your input cost significantly. We have tried to do a comparative metrics. What was the situation before 1st July 2012 and what is the situation after 1st July 2012? So generally in most cases, there is no fundamental change. But I'm sure you must be reading in newspaper, like I just saw in today's newspaper that the builders lobby, they've received notices from 2006 to 2010 that whatever they've sold the houses or offices, there is a VAT applicable on that also. And the Supreme Court has given some relief that they can make the payment before 31st October. So many industries are getting impacted. I think we need to assess in our own case what is the impact. I will not go into detail, but we have tried to do a comparative analysis of all on the sales side as well as on your cost side, and what is the change in the regulations. Like bank charges, insurance, rent, in terms of your brokerage, what you pay to the DTC brokers, you may be paying also commission to your marketing, agents outside India. All this will get covered under the service tax if it is already not covered in the past. So to summarize, there is a need to ascertain the impact of service tax regulations. It is a very significant item for most people. Ensure payment of proper service tax under the reverse charge. Review certain expenses for ascertaining service tax charge such as commission and import of software. Even import of software, there is an issue about service tax levy. And claim applicable exemptions, particularly under the mega notification or under in case of SEZ units, with proper documentation so that you don't get into litigation tomorrow. Thank you very much and have a good day.
Thank you, Dr. Surana. It was a very insightful presentation, Dr. Surana, and it reminds me of one of my earlier days. And I would like to share this with the audience. When I had initially started my career and I was very gung-ho, I'm earning, I've got a salary, I've got a PAN card, now I'm going to file my returns. I got a credit card, I started spending, and then came the time of March. So they say you need to file your returns. So I said, okay, no, get me the best CA in the city and I'll go to him. So friends recommended, why don't you do it through me? Why don't you do it through me? I said, I need the best. And then somebody recommended me a particular CA. So I went to him with all my documents and everything. And I said, can you help me sort this out? Can you file this for me? So he looked at my papers and everything. He pondered over it for 15 minutes. And he said, it's difficult. And I said, what's so difficult? I've just barely started earning. And it's a simple thing. It's going to take you 2 minutes to do it. If I had paid attention during my commerce days in college and if I knew the golden rules of account, I would have done it myself. Pity I didn't do it. He said, well, tell me what do you know about accounts? So I said, all I know is, I know there's a balance sheet, which was there in my third year. I didn't score well. I'm sure it didn't tally. I said, that's the reason why you probably don't know. So I said, listen, I know in my personal accounts, there is a liability side and there is an asset side. So he said, great. You know, son, what's wrong with it? I said, no. Well, let me tell you what's wrong with it. On your left side, there's nothing right. And on your right side, there's nothing left. So I said, okay, so I'll try to work on it. And that's the reason, that's the lesson which I got. Try to keep the left right and the right left, but it's still not happening. So anyways, I hope one fine day I'll be able to do it, and some of those insightful lessons I'm able to practice during my future days as well. So thank you, Dr. Surana, for a very wonderful, insightful session, and I'm sure it's helped most of us out here. Our next speaker for the day, Mr. Rohan Shah. He's not present with us today. It's been a little unfortunate that due to unavoidable circumstances, he could not make it here today. But we do have Mr. Nishant Shah, who is also a partner with Economic Law Practices, Advocates and Solicitors. His major area of practice comprises taxation, both direct and indirect, with special focus on indirect taxes such as excise, customs, service tax, central sales tax, state levies, as well as regulations under the foreign trade policy. In his area of expertise, he has worked on assignments relating to transaction structuring as well as litigation matters for various corporates and multinationals. He has also been instrumental in making representations to the central government on behalf of industry associations and anomalies in various Indian laws, including tax benefits arising to exporters, simplification and streamlining of procedures in relation to international trade. He has worked extensively for the gem and jewelry industry in relation to making presentation to the central government on issues such as introduction of presumptive basis of taxations, custom duty abolition, etc. As a part of a new initiative, he has been working on developing expertise in relation to anti-money laundering and related laws recently introduced in India, including its implication for the gem and jewelry industry. He has also made presentations and addressed seminars and conferences organized by industry associations and professional organizations. He has worked extensively for the state government of Rajasthan and Punjab on implementation of the VAT regime in those states when VAT was introduced in India. He has also assisted a number of companies in the transition into the VAT regime. Prior to this, he has worked with member firms of Deloitte and KPMG. Ladies and gentlemen, it gives me a great pleasure to invite Mr. Nishant Shah on stage.
Thank you very much. Thank you for this opportunity. The coverage of my presentation is mainly covering the anti-money laundering provisions. India has been new to the anti-money laundering provisions, and more so from the gems and jewelry sector. Anti-money laundering has been prevalent in India, but it has been restricted to some of the sectors, that is banking, insurance, and regulatory. However, the gems and jewelry industry per se, and specifically the diamond industry per se, across the globe has not been new to anti-money laundering. US, Europe, most of the other leading nations also have already introduced anti-money laundering regulations or compliance requirements for this industry. It is therefore important that India starts understanding those, because India is a signatory to the FATF, and being that it has already taken on the onus of extending the anti-money laundering provisions to the entire gamut. So what we are going to be discussing today is some of the important aspects which are likely to be brought about under the prevention of anti-money laundering law which is currently prevalent in India, which is likely to undergo a change. There is already a bill pending before the parliament which brings about certain changes, which changes are actually far-reaching and brings into its coverage the gems and jewelry industry, more so the diamond industry. An overview of this industry, enough to say that this industry is significant enough for the government to ensure that it attracts enough attention that if any regulatory compliances are to be brought in, or if it results into India's positioning in the global map, the government is not going to be going slow on that. It's going to attract the maximum attention. More so, considering diamonds, because of the unique dynamics that the diamond has and its possibility of being carried and handled and the concerns which it carries around it, it is more relevant that the diamonds are going to become part of the anti-money laundering regulations in India, which it is already proposed in the bill which has been announced so far. There is already a headline in the Times of India which we had about last month, which says that diamond trade is highly susceptible to money laundering activities and therefore the government is looking at expanding the anti-money laundering provisions to this industry. It's therefore important that this industry gears up, understands the provisions and starts working towards it so that when the provisions are actually made applicable, it does not come across as a shock or it does not take too much time to acquaint with it. Considering that, some more news articles and things, but we move ahead. Now, what is money laundering? Money laundering has, in simple words, been defined as the process of deceiving the regulatory authorities as to the origination, existence, and or application of illegal sources of funds, and subsequently processing those funds to make it appear as if they were from legitimate sources. Money laundering has been considered as having the third largest turnover after petroleum and foreign exchange. Mainly, what is money laundering now? When we look at money laundering, it's basically the placement of illegal funds into certain activities, which activities then are layered with certain other complex activities, and it resulting into those laundered funds coming back into the legitimate regime, and that is basically money laundering. Now, to avoid that money laundering, there are various regulations which have been introduced in most of the nations, and it has gained much more importance after the 9/11 incident, because money laundering has been considered as also assisting in terrorist financing. From a gems and jewelry sector, the reason for susceptibility to money laundering is that diamond and jewelry are recognized substitutes for currency. Liquidity of the asset, high value of commodities, easy to carry, not bulky, etc. These are certain salient features which make it very easy for these products to be carried in the laundering process. Owing to the unique variables of this industry, it is also difficult to determine as to what is the value of, say, a certain pack of diamonds or a certain bunch of diamonds, and therefore again the valuation or the recording thereof in the books can result to some sort of distortion, resulting in again into money laundering. And therefore this is all to emphasize on the fact that money laundering is going to come across on this industry. In fact, it is already there in the bill, and what are those provisions which are there is what I intend to discuss in the following slides. Now, before we go on to what India is going to adopt, let's understand what the global scenario on money laundering is. In 1990, the General Assembly of United Nations had made a political declaration basically to curb money laundering. In 1998, the United Nations called upon its members to initiate anti-money laundering provisions under the aegis of FATF, that is the Financial Action Task Force, to which India is a signatory. There were 40 recommendations made out, and there were another 9 recommendations made out, basically initially for the money laundering, to curb money laundering, and thereafter the 9 to combat terrorist financing. India, being a signatory to it, including the 2 other organizations, is completely bound by the FATF recommendations and is bound to adopt those and implement those. India is also part of the Asia Pacific group, which is a group formed to exchange informations. Being a part of the FATF and the Asia Pacific group, India has a fiscal intelligence unit, which is the head unit which collates data from each of the different entities which are required to be following money laundering provisions, and takes it up for exchange between nations. And therefore it's not at a lower group, but it's a very high group that money laundering is becoming applicable in India. The FinCEN is the similar procedures which are, or similar law which is applicable in the US, and FinCEN actually covers gems and jewelry units, and therefore even Indian suppliers to US are normally required to undergo the FinCEN regulations, or otherwise Indian supplies are normally to their subsidiaries in the US, which then avoids this kind of regulations to be gone through in India. But therefore, if you want to have a healthy relationship with the US or the transactions, it's important that money laundering provisions are made applicable in India as well. Now, from an Indian perspective, India had already made applicable the Prevention of Money Laundering Act, which is the act in relation to prevention of money laundering in India. And there were various rules which have been brought in, which have been talking about the methods, the record keeping, the scrutiny, the compliance procedures, etc., to be undergone by various companies. Companies which are covered under the PMLA as of now. But thereafter, there is a new bill which has been brought in, and that is the 2011 bill, and it is very significant because, one, it does not only expand the ambit, the coverage, and the onus under the money laundering law, but it brings within its ambit a lot of other industries, including the gems and jewelry industry, including the diamond industry, including the bullion industry. The bill was referred to the Standing Commission because there were certain provisions under the bill which were quite onerous, and it was considered that it will be too difficult for businesses to carry on if such a provisions were brought in, and therefore it was put forth before the Standing Committee. The Standing Committee has given some of its recommendation, which has again been put before the Parliament, and we may see the bill being passed out very soon. Now, what are those provisions under the PMLA and what are those provisions under the new bill which are likely to affect us? Let's take a bird's eye view on those. I know that we are running on there is paucity of time, and therefore I'll be touching upon some of the significant aspects. The PMLA talks about the money laundering as who is considered to have laundered money. Whosoever directly or indirectly attempts to indulge or knowingly assist or knowingly is a party or is actually involved in any process or activity connected with the proceeds of crime and projecting it as an untainted property. That means, if there are some proceeds of crime, and proceeds of crime has been defined separately under the law, which is basically any kind of proceeds which have been considered as illegal under a whole series of legislations, and which includes FEMA and income tax and customs. So it's important that these acts have also been covered, and therefore any violation under those acts will consider those proceeds as proceeds of crime. Now, what has happened in the finance bill, the new bill which has been proposed, is that the proceeds of crime and projecting has been modified to say proceeds of crime including its concealment, possession, acquisition or use, and the projecting or claiming. Now, even mere possession or use is considered to be laundering of money, which means if there are 3 different layers of transactions and we are part of the 3rd layer of transaction, but if it is laundered money which comes even at the 3rd layer of transaction, you are knowingly or unknowingly holding that money, concealing that money or using that money. So concealing of course is a crime, but even just mere holding or using that will be considered as laundering of money, and therefore the onus is much wider now as compared to earlier. In addition to that, the earlier provisions had a limit of 5 lakhs to be the fine. That limit has gone away. That means there is no upper limit up to what the fine can be. Moving further, what are the onerous requirements under the PMLA? Under the PMLA, there is a requirement for maintenance of records. Now, earlier the requirement for maintenance of records was in relation to banks, financial institutions and intermediaries. The new bill which is being proposed is expanding that to reporting entities. What is reporting entities? We'll be touching upon that very soon. But what is a reporting entity required to do? A reporting entity is required to maintain record of all transactions which are considered to be suspicious transaction. Again, suspicious transaction has been defined. I won't go into the definition because it's wide enough. It's not just wide enough in its coverage, but even for me to read it out, it's wide enough. So I'm not getting into that, but it covers suspicious transactions and transactions based on certain value, and right now the value has been kept at 10 lakhs, which 10 lakhs threshold, I fear that, considering our industry, 10 lakhs would be, quite a few transactions would be getting covered under that. Furnish information of transactions referred to above to the statutory authorities and verify and maintain records of identifying of all its clients and prescribed manner. I know that most of the industry members now have adopted KYC norms, but otherwise KYC norms are being made much more stringent under the PMLA. I'll just touch upon that how KYC norms have also been made stringent. The records need to be maintained for 10 years, and the obligation also extends to transaction or series of transactions. So if one transaction is not about 10 lakhs, but a series of transactions in a certain period is about 10 lakhs, even that gets covered. So that increases the onus, that increases the burden, and that increases the record keeping. what is the new bill talking about? The new bill brings about within its coverage, not just earlier, the bill was covering banks, insurance companies and brokers. Now it covers reporting entities, and reporting entities within its definition, which has a lot of other entities, also covers persons carrying on designated business or profession, and that includes dealer in precious metal, precious stones or other high value goods, as may be noted by the central government, whatever has been prescribed. And precious stones has been defined, or precious metals has been defined as gold, silver, platinum, etc., etc. Precious stones has been defined as diamond, emerald, ruby, sapphire or any other stone as may be notified by the government. Which means that now, once the bill is passed, this law directly becomes applicable to our industry in its totality. The rule under 12 is intended to be much more stringent than what it was currently, and therefore there is an urgency, or in fact there is a need that the industry starts gearing up itself to be ready for this new law which is likely to come in. We had earlier created some sort of a study or some sort of a compliance manual which can be adopted by the industry, and if that manual is to be adopted, it could be implemented voluntarily before this law becomes applicable on its own. Under section 12 again, now some of the other aspects which are there, and this is the second part of the slide which I wanted to emphasize on, is that the maintenance of record is required to be in relation to certain types of transactions and certain types of value of transactions. More importantly, the maintenance of record is required for evidencing identity and enabling verification of clients under the new law. And what is client? Client is a person who is engaged in financial transaction or activity with a reporting entity and includes a person who acts on his behalf. So he is agent. Client or client's agent is you need to maintain record. That is your KYC norms. KYC norm doesn't end there. KYC norms has been extended under the new law to say even the beneficial owner. Who is a beneficial owner? Beneficial owner means an individual who ultimately owns or controls a client or a reporting entity or a person on whose behalf the transaction is being conducted, and includes a person who exercises ultimate control over the jurisdiction over the judicial person. Which means you have certain information of the client that's not good enough if an entity is purchasing, but you need to know who is the ultimate owner of that entity is also required to be known here, and that will be critical, which creates a lot of onus on the entities, because your KYC norms are geared enough to find out who is the ultimate owner, or if there is a company which has been promoted over and above the ultimate owner, even that would be required. In addition to that, the records are required to be maintained for 5 years. The standing committee has said that the 10 years should be reduced to 5 years. As regards the monitoring requirement on the beneficial owner, as I explained just now, the standing committee has recommended that beneficial owner should be restricted only to certain suspicious transactions and not to all kinds of transactions, otherwise it could lead to restriction of trade. And finally, there are certain reporting requirements. If the reporting requirements are not followed effectively, there could be a liability which could be to the tune of 1 lakh for each failure that is made. What is important is that under section 12(5), the central government does have the power to exempt certain entities from being nominated as reporting entities. Therefore, if there are certain situations or certain characteristics or certain kind of transactions which need to be brought to the attention of the central government, it needs to be done now, that these onerous or these critical provisions cannot apply to those kind of entities or those kind of transactions. Next we go to section 24, which stipulates that the proceedings relating to money laundering, the fund will be presumed to be involved in the offense. Basically what it says is that earlier the provision was that the officer needs to prove that there has been an offense to consider a person to be involved in money laundering. Now the officer has the ability to presume. So whether it is or it's not, so as long as the officer presumes that there is a liability, he can still attach the property. And when he moves in to attach the property, the attachment of property norms are quite onerous enough. The attachment has been extended from 150 days to 180 days, and most critically, he can go in to attach stock in trade, which is most violating, because stock in trade normally could result into restraint of trade because your business can stop progressing, and therefore under income tax law also when they apply attachment provisions, stock in trade can never be attached. However, under PMLA they have not given any exemption to that. Even your stock in trade can be attached. There has been a new concept of corresponding law which has been brought in, and which says that if there is an allegation arising under a similar law in another jurisdiction, and if you've been acquitted from that law and that jurisdiction, that can be brought forward to the local authority, and the local authority also has to compulsorily acquit you. That actually is giving a beneficial provision. However, the standing committee has given a recommendation to say that that should not be, because otherwise the local authority loses its power, because if you get acquittal from a foreign authority, then the local authority will not be able to take action against the Indian entities. Some other provisions in relation to offense and the consequences of those offense. Any belief, a mere belief also, belief in relation to possession of proceeding of crime, and that such proceeds are likely to be concealed, transferred, etc., can result into provisional attachment of the property. It could also result into seizure of record and property in the course of investigation under Section 17. Offense of money laundering under Section 3, which I read out earlier, could result into imprisonment and attachment of property again, and non-compliance, which is quite onerous here. Even non-compliance could result into monetary penalty to the tune of 1 lakh for every failure which is made on non-compliance. Certain provisions in relation to attachment of property, I have discussed this earlier. Just one last point, that requirement of a person to have charged, having been charged of having committed an offense is done away with. As I mentioned earlier, that earlier there was a requirement that a person has been committed an offense was required to be brought in by the officer. Now the officer can presume that there is a committal of offense, and based on which he can take action. So basically, in view of these new provisions which are likely to come in, and the existing provisions which are likely to become onerous, it is important that this industry looks into the development of entity-based internal policies, procedures, controls, etc. to comply with these statutory provisions. It's very critical that somebody is appointed or designated as a compliance officer and is responsible to undertake the money laundering compliance, and therefore he being called as the anti-money laundering officer. The KYC norms need to be introduced, not just introduced, strengthened to cover the client and the beneficial owner. Transaction monitoring system to be put in place, and suspicious transactions to be tracked in line with the provisions which are brought in under the new bill. And finally, the industry compliance standards need for creation of internal money laundering guidelines, which will be strengthening the overall program, the overall procedures and overall compliance requirements under this policy. With this, I conclude the money laundering portion. Just one slide on the customs developments. I was told that there will be interest on customs. There have been some customs Development, as Dr. Surana also mentioned, that the custom duty of 2% has been brought in on cut and polished diamonds as well as colored gemstones. The levy basically was attempted to curb round tripping, which had become had got some highlight. There is another exemption which has been brought in, that where the goods are brought in for certain grading or certification purposes, then it is not required to undergo customs duty. Other than that, there have been some increase in customs duty on gold bars, tola bars, etc., gold coins, increase in rate of customs duty in respect of gold in any form of tola bar, and increase in customs duty on platinum. With that, I conclude my presentation. I'll just request my colleague Ajit to come in for this. Before that, handing it back to Prashant. Thank you.
Thank you, Nishant, for this wonderful insight on and the knowledge gained on PMLA and KYC norms, and also showing us some more information about customs and giving us a way ahead. Our next speaker for the day is Mr. Ajit Tolani. Ajit Tolani is a partner and heads the transfer pricing practice of ELP. Before ELP, he was working with a Big Four accounting firm leading a regional transfer pricing practice in India. Ajit's experience includes working on transfer pricing, advisory, and controversy work in India and internationally in the US. Ajit advises clients on the review and documentation of existing transactions, planning for new transactions, and preparation of global transfer pricing policies. He has represented several clients before the field appellate authorities and negotiated bilateral APAs between the US and Canada and the US and Japan. Ajit has also advised clients on supply chain management and helped them in implementing tax-efficient supply chain structures. With this, I would like to invite Mr. Ajit Tolani for his presentation.
Thank you. Dr. Surana already introduced the topic of transfer pricing to you, and the reason we thought of doing a little bit of extra deep dive into this topic is that This topic has been assuming significance over years in India and across the globe, and especially now in the gems and jewelry sector. So the prime point which we'll cover is the introduction of these new domestic transfer pricing provisions and how they are going to really affect gems and jewelry industry as such. But before that, really look at it. Let's look at this slide, and this slide will really tell you that why transfer pricing and how it has been assuming significance. Now, in India, your transfer pricing audit is a yearly process. Every year it happens. And we have already gone through 7 rounds of audit. Now, if you see the first round of audit where the tax authorities went, scrutinized books of every multinational corporation or the corporation having a cross-border trade with group companies, there were somewhere around 1,220 crores in the first round of audit, which is, if you see, now moved on. In last audit, the adjustments proposed were around 45,000 crores, $9 billion. So the tax authorities, this shows a lot of aggression on the part of tax authorities. But at the same time, tax authorities can never be so aggressive unless they are able to figure out some loophole in our documentation or the positions which we have taken. This shows to a larger extent a lack of documentation which the companies have been maintaining, or the kind of very standardized approach everybody has been following in the market. And more so, if you see between 2007 and 8, which are the last 2 years, the adjustments doubled, literally from 23,000 crores to 45,000 crores. Now, this transfer pricing assessments were more on the international side, and government realized the potential, what these provisions can bring in as a tax revenue. So they have now extended to the domestic transfer pricing on your domestic transactions. Now, really, the government has been very, very cautious and very, very smart in bringing the applicability or making these transfer pricing provisions applicable to the domestic transactions. They've actually not covered the entire spectrum of transactions which you do with your group companies here domestically. They have covered only specified transactions. So there are only 2 broad categories which they have said that we will cover only those, and not each and every transaction happening between the group companies. Now, what does this mean? This means that, okay, whenever you had an international transaction, you were maintaining documentation, which was already a very, very onerous documentation to maintain. You'll have to maintain similar documentation for your domestic transactions. We, especially gems and jewelry industry, is very used to going to a local assessing officer for assessments or audits. Now you'll have to go through one more additional round of audit. You'll have to go through a transfer pricing officer who will conduct your transfer pricing audit. And it has been known that at least in 90-95% of the cases, those guys end up making adjustments and making some additions to your income. Earlier, there was no really penalty for non-compliance of these provisions. Now they brought in these new penalties, which says that if you do not disclose the transaction in your Form 3CP, which Dr. Surana was mentioning in his speech, as an accountant's report, you have a straight 2% penalty. Now, your whole industry really works on margins of 2%, 3%, 4%. In that, if you really miss disclosing something and you end up paying an automatic penalty of 2%, that's really would be a complete killer for your business. That's where these provisions assume significance. As I was saying, it covers only 2 categories of transactions. The first category is when you book an expense in your books as an expense paid or to be paid to a related party. So there is no income cost. So let me give you an example. So if I have a product worth 100, which I can sell, but if I sell it to my related party at 98, it's fine. You're not covered in transfer pricing. But if I buy something from my related party, really, instead of if 100 was the market price and I buy it at 101 or 102, then that creates a problem. Now think about it, why government would do something like this? It's basically done not to give you a corresponding adjustment. So assuming the tax officer makes an adjustment in case of entity which has booked expense. So it has booked expense of say 102 instead of 100. So tax authority will say, okay, your expenditure is high by 2. So I hereby reject your expenditure. Correspondingly, since your expense is rejected, your income would be higher to that extent, and you will end up paying taxes and interest and penalties on that. But the other entity, now for you, this was an expense, but this was an income also for someone else, right? So someone else booked income at 102, but he will not get a corresponding adjustment for reducing his income. I mean, in a transaction, there are 2 sides. It balances off. Now, to avoid not giving you adjustment or a corresponding benefit on the other side, they have not covered the income portion in the transaction. So it clearly shows government's intent to really chase you whenever you book any expense. B, make an adjustment if you're not, if you haven't documented your positions correctly or appropriately. And C, not to give you a corresponding adjustment, which ultimately means you have a double taxation. So you pay tax here again by reduction of, by disallowance of your expense, and you have already paid tax when somebody else booked income in his books. Second category is more for tax holiday units. It's actually I mean, I'm sure a lot of you who are here, you know that this finance budget was all about reversing all earlier court or tribunal rulings. So the second, this change which has been brought in, it has again been brought in to reverse some of the court rulings, which said that, and especially those are happening more on the IT industry side, wherein the SEZ or in the tax holiday units, they will declare super profits so that they can claim higher tax holidays on that. And that was challenged by government using transfer pricing mechanisms, where the court said that no, transfer pricing is a separate law, you cannot use that for adjusting any profits of tax holiday units. So now government has made that. Now having said that, in a very, very simplistic way, so if you have tax holiday units, you really need, and the tax holiday unit has any inter-unit transfers or any transfers with other group company, then you need to be a little cautious on how your profitabilities are, or what are your transfer terms with your other eligible units, and whether they are really compliant of the arm's length. And I'll give you, what is this whole noise about arm's length? Now, how life has changed. See, these provisions were always there. Now, if you focus on this slide, say there is a transaction, I'm doing a transaction with my related party. So I am maybe S is a unit earning some sort of profitability, or I am doing it on a pricing basis. And my market benchmark pricing for similar transaction is say 25, 50, 75, 90. Now it's a dynamic market, keeps fluctuating. You have various price points depending on your positioning in the market. So earlier, you could have said that, okay, if I am anywhere between 25 to 90, which is my price points, or which are my benchmark points, I am fine, because that's where I can fluctuate in the market. But they say that now, no, you will have to be compliant with with the transfer pricing regulations, which means you have to be compliant with arm's length principle, which in a very simplistic terms means that whatever are your price points, you need to take an arithmetic mean of all those price points, and you'll be benchmarked against that. Now, considering you having a purchase transaction, so many transactions during the day, during a week, during a month. Now, earlier, as I was saying, you have flexibility to position anywhere, but now you have to be at least at 60 in this example. So either you have to be at 60 or below 60. So assuming I'm purchasing a diamond from my group company, so I can purchase only at 60 or below it, but not at 75, because although 75 is also a market point. So that's where now your flexibility will get restricted when you do transactions with your group companies, especially on the purchase or the sale side. Having said that, so really arm's length pricing is the concept of transfer pricing. There are methods, there are procedures prescribed like any other law, any other thing, and you have to fit yourself into one of these methods. Now, the challenge which we have seen in gems and jewelry industry more so is that everybody in the marketplace uses only one method, only one standard set of comparables, only one standard set of margins. But nobody really realizes that A, your characteristics of your transactions can be different than others, and B, if it is different, then why you should be benchmarking yourself to a standard set of comparables. The problem of this is that if you follow a standard set or standard approach, and there is an adjustment in some odd case in one case, the tax authority follow that adjustment in each and every case. And that's what the challenge we have seen a lot in the gems and jewelry industry, which has been happening. Now, just to step back a little bit, as I was saying, expenditure is covered, but expenditure is covered only when it is paid or to be paid to a related party. The related party has been very oddly defined. It says that A, it has to be with a company in which either I have a substantial interest or my director has a substantial interest, which is basically a 20% threshold, or any of his relatives, and relative means brother, sister. So assuming I am a company, I have a director, and his brother or his sister owns 20% some other company, and I do transaction with that company without knowing that his brother or sister owns substantial interest, that also is covered into the domestic transfer pricing arena. And this was really not earlier covered on the international side. So your disclosure requirements are more whenever your accountant makes a report, he needs to be now a little bit more vigilant. You'll have to take declaration from your director so that he declares you at the time of taking the directorship, saying that, okay, I own substantial interest or equity interest in following companies, my relatives own in following companies. So you'll have to go through all these processes just so that you are compliant. And as I said, if you don't comply, you have a straight 2% penalty for non-disclosure of those transactions. How life has changed for you? You need to maintain this documentation, which is fairly detailed documentation, and I'm sure those who have international transactions already are complying with the documentation requirements by way of benchmarking studies, doing the functional characterizations, and all those things. Here are the penalties, and the one in red is the one which is newly proposed. So if you ask me, you need to be a little cautious of the one in the red. The rest all are still falls in place through showing the motive that, oh, I did not have motive to conceal or cheat or do anything. Whereas this red, the one in red is automatic penalty for non-disclosure. So the moment you fail to disclose, you are immediately liable for this. And as I was telling you, that your trade only is at 2%, 3%, 4%. So you want to be very cautious with this one here. Very summarized way, what is the impact for you? Watch out whenever you book an expense with your related party. Also, here I'll like to give you some example. If you see on the international transfer pricing side, some of the interesting and landmark rulings are from gems and jewelry industry. Say extended credit period, interest on loans. Why? Because your industry is really susceptible to these transactions, and of course you have these transactions more than anybody else in the market. Same way you will have these similar issues on the domestic side. You will somewhere end up setting some landmark rulings, and I'm sure we don't want to be setting up landmark rulings in the market, and we rather want to be more cautious and fixing it up upfront. You now have time. International side, when the transfer pricing regulations came, they were nascent. You don't have many consultants, you don't have many knowledgeable people in the market who could have really guided you perfectly, and now the law has evolved. So you have a good set of people who can guide you, advise you, and you have this whole year in your hand because any audit or anything which will come up will be for year ending March 2013. So do your preparation. Whenever you're booking your expense, have a discussion with your consultant on how you should be doing it, what is the arm's length benchmark, what is the right way of making the entries. Sometimes just passing an entry in the book, although the way you pass the entry in your books can have major impact on the transfer pricing side. Transactions, if you have with your SEZ companies or tax holiday companies or tax holiday units, watch out for those. Be ready for your additional tax assessments which will come up. Please avoid penalties. I don't think you are an industry which can really afford these penalties. Very quickly, as I was explaining you the issues, please, what we have seen in the litigation process, all these matters, everybody is standardized. Maybe standardization is also one of the good approaches, we agree, but at the same time, you should be asking more questions. You should be asking, or you should be documenting your transactions more clearly in your documentation so that at least when it comes to some positive characteristics on your side, they come up. They come up in your documentation. If you won't document and you'll have a straight jacket, copy-paste studies, copy-paste benchmark studies, copy-paste comparables, having those 3 odd comparables in the market, it won't work. As Dr. Surana was also pointing you out, many times using foreign companies' profitability helps. Because what is, end of the day, transfer pricing is about transaction at a right price. If my foreign party didn't end up, one way of justifying transfer pricing is that either I sold it cheap or I bought more expensive, or other way to show is that the other guy whom I sold, that also didn't make any money, or his intent was not to make money. So there's another flip side, helps a lot, but if you yourself in your documentation won't document these factors upfront, you will always end up losing the battle. Trust me, out of those first slide, 45,000 crores which I was showing that time, 30 to 40% matters are only because of lack of documentation or lack of poor documentation. Here again, it looks, these are very 3 typical, we making a very simplistic example. 3 trading structures. You buy from unrelated party, say rough, buy from mines, sell it to related, buy from related, sell it to related party, or buy from related and sell it to unrelated. Everybody in the market is using only one method and one set of comparables. No, that's not wrong. There are prescribed 5 methods, and there are all these different methods applies to these 3 examples, which will be for your benefit. So avoid straitjacket approaches. Way forward for you is that please, you have this whole year in your hand for domestic transfer pricing. Do your impact analysis. Have a discussion. Whoever is your consultant, you want expert advice, go to expert, talk. You have whole year in hand. If you won't structure, trust me, you will end up making some nice landmark rulings which will be for benefit of our lawyers in terms of arguing your matters in the courts and using those as a benchmark for some other cases. Do your planning based on impact analysis. You may end up figuring out that, okay, I'm doing 10 transactions, but only 2 transactions are the one which need my focus. So you focus on those, plan for those, and structure those. And at the year end, once you have these structured, the third will automatically fall in place, which will be your documentation, saying that I've already gone through this process of planning, and here is my position on that. That's it. Thank you very much. We'll have, I think, separate Q&A session.
Thank you, Ajit, for sharing this information with us. It was indeed very informative.